Hi, everyone. This is Rob Roy of EWO Options, and welcome to this special session on our risk management update. Over the past couple of weeks, we've been talking about some changes, some research that we've done, collecting data, et cetera, on ways that we feel like we can make some slight changes in our risk management profile that'll be helpful for everyone moving forward. So that's the idea for this session. And as you're used to with our videos, we still have to show you this disclosure/disclaimer. It is important. If by chance this is the first video you're seeing, please take a screenshot of it, read it in detail at your leisure. A couple important things. Number one, we're not registered to give individual investment advice in the United States. And number two, the pricing that we're talking about is assumed to be in US dollars. Unless noted otherwise, because we have a lot of international subscribers. They feel that that's important for us to point out to you. So welcome, appreciate your attending. For those of you on YouTube, welcome to you as well. And brief rundown of what we're going to talk about this evening. We're going to go through an overview and the rationale of the changes that we're going to be implementing. We're going to talk about a restriction of sorts to our high value availability. All of these things that we're talking about here in the overview, we're going to go through in detail. So if you have questions as I go through there, please understand that we will go through these in detail. We'll talk about how we're going to separate out our impulse versus speculative trades, i.e. momentum, et cetera, trades that come from other searches. We'll talk about the revamp of our volatility exit strategy. Going to spend a bit of time there, have a ton of research and data to share with you there that I think you'll find very eye-opening and enlightening. We feel that you will. And then we're going to do a brief introduction of the new strategy. We've been talking about it for quite a while, our income strategy that's soon to come out. So we're going to give you a nice preview of it this evening. So hopefully you'll find all of that very informative. Tonight, we have John with us, I believe, for support, and bring him on in just a minute, but just a couple things. We have John because he has a bit of a good programming background, was very instrumental in collecting all of this data that we're going to be sharing with you. So he has firsthand knowledge of it, how it works with that background, and you're aware from previous sessions, his trading acumen as well. So good to have John with us. Are you there, John? I believe he's with us.
Hi, Rob. Yeah, I'm here.
Okay,
ready to go. Thank you for having me. Looking forward to it.
Good. I was saying that you were here before I knew for sure, so I'm glad that you're here. And as we've done in the past, would you run everybody through real quickly the process of asking questions?
No problem at all. I think as we agreed earlier, because this session is really a lot of information, we're going to get Rob to hold his Q&A session at the end. So we're not going to stop for questions throughout. However, as we're going through the presentation, please feel encouraged to go ahead and put your questions into the Q&A, and I'll keep track of them and try and organize them so that I can give Rob a number of questions that are all related to the various sections that he may have covered when we get to the Q&A at the end. So as I said, please feel free and encouraged to go ahead and put the questions in the Q&A as we go, and Rob will answer them at the end. So I think I got everything there, Rob. Yep. Back to you.
Appreciate it. Thanks, John. So let's get started on this special session. And again, I think this is going to be really eye-opening, and everybody's going to feel really good about the changes that are coming along. We're excited about them as well. So why are we making changes to our risk management? Well, the main thing is we want the best possible outcome for all of our subscribers, and we identified some things, some from the feedback from you, some from our own research and data collection, things that we feel that we can maximize. And that's one of the great things about this technological world, is there's so much data available for you, and you can really hone in with the computerization that exists today and pinpoint things. And that's what we've gone and done. Options trading is challenging. As you know, we always talk about options trading should only be done with at-risk capital, money that you can't, that you can afford to lose, if you will. And if you have less experience or limited trading capital, then that makes it even a little bit more challenging from that standpoint. So Consequently, with a few years of track record, so Wave Options has been around for a few years now, both in terms of trading and supporting customers. As you know, that we have a really good system, a support system where you can ask questions to our support staff. They funnel questions on to me if you would like to ask a question directly to me. So we do receive a lot of feedback, and we ask for your interaction on ways that we can improve the feedback. And we do our Thursday night, which we'll be doing this week as well for the insiders meeting. And in addition to all of the other support methods that we do for communication, we want to be open, transparent, and communicate well. So with all that information that we've collected, we feel that we can improve the experience. And most importantly, I think you would agree, the success of our subscribers, all of our subscribers in general. So this is some from your feedback, and these are things that you've listed as challenges that you faced as our subscribers, and let us know. And again, we listen and we hear you, and that's the whole reason for going through and identifying what ways can we make this a better experience for everyone, all of our subscribers. So some of the challenges are having enough capital to follow the adjustments as well as take on the new trade alerts. And we talk about this a lot. I make adjustments, and it's just been my theory that if there's still a viable pattern, just because a trade is going the wrong way or has run out of time, there's no need just necessarily walk away from it. If we can adjust it, whether or not we're adjusting for position to keep a profit in a trade, or if we've gone through and the pattern has changed. As you know, one of the great things about Elliott Wave is the evolution of the pattern formation. In other words, if you have a pattern that's set, but that pattern becomes disqualified, there's immediately a new pattern that becomes available, or often there's immediately a new pattern. And so why walk away when statistics show, the math show, that that secondary pattern, when one has become disqualified, has a higher percentage chance of hitting its target than the original one did. So just to walk away at an X number of loss and then move on to a new one that has that same initial percentage of potential profitability, when we're walking away from one, although we've had a loss or at a current loss from a position that has a higher percentage chance, it just doesn't make sense. But it's important to understand these things. And I get it if you're not that adept in Elliott Wave, if you're newer to Elliott Wave or to Elliott Wave options, these are the things that we're trying to educate our subscribers on. But with all that said, there still becomes the issue of there's limited capital, there's limited buying power. So if we get involved in too many adjustments and it uses up all the buying power, well, then you don't have enough buying power to take advantage of new trade alerts that come out. And we had a really nice run there, especially in the energy sector, of very short-term trades in and out, nice profits in a very short period of time. Well, some of you weren't able to take advantage of those because your capital was tied up in other alerts that were going through the adjustment process. So we feel like we've hit the sweet spot here now on ways that we can adjust the risk management style to take care of that issue. Another issue that's come up is maintaining your confidence when we have options positions that are expiring worthless. And I went through this a couple of weeks ago as well. I know from a psychological standpoint, nobody likes to see a position expire worthless, but we're going to show you some math that backs up what I've shared with you in the past on why we have positions that we hold to expiration due to what happens with the fact that delta and gamma become more in our favor. But then you have the fight, and you're going to be able to see it in the data, which I think is really going to be cool. Visual. I'm a visual learner. You know, we all go through, and in school we learn that there's different ways of learning and people learn in different ways. I feel that I'm a visual learner, and so I like it when things are in pictures and graphs, and we have that to share with you. So we're going to show you. We're not just going to talk about the data. We're going to show it to you and put it in graphic form, and you'll be able to see real graphic representation of the math that we've been talking about. So the psychological aspect still stays, though, so we can justify it, but that doesn't take away the psychology. So what can we do to help that? Well, that's what we're going to talk about. Understanding why case studies remain open while positions have expired. And so again, talking about the methodology that we've been undergoing is the fact that if we have a position that does go and expire worthless, so it's already not feeling good, right? Because it went to expiration and expired worthless, but the new pattern has not triggered yet. Sometimes there is a little bit of a time frame between when a pattern becomes disqualified or doesn't hit its target or makes a change, and when the new one triggers based on our indicators. Well, it's been the methodology not just to put on a new position prior to expiration, just to make sure that there's no gap in time. That doesn't make any sense to me if you're just putting a position on for the sake of having it on. That's just going to create bigger losses if you don't wait until your indicators tell you, okay, it's time to get in. And if you go back and look at our history, a lot of you new subscribers that have come along, we had a lot of new subscribers that were added in the month of October, and you've gone on the website and you see some of these positions that are still showing open, but haven't been closed out, and a position has gone to expiration. Well, if you go back and look at the rest of the alerts, you will see that there are other alerts that had that same scenario where there was a gap in time when one alert ended before the new one was sent in, and the adjustment process worked out really well in most of those cases, sometimes turning the position back to a profit and other times regaining a vast majority of the loss. So that's the reason. I just wanted to go through the explanation. Now, with what we're going to share with you, we're making changes. And so some of these things are not going to be issues anymore, but I still wanted the explanation of why we did things the way we did. I think it's important for you to understand the methodology, and then we'll show you why we're making the changes that we're making. And I think, again, everybody's going to be really excited about the changes, but the understanding of why we've done what we've done in the past, I think is important. We're not necessarily saying we were wrong. We're not saying that we haven't done things with what makes sense from the math with the Greeks and everything else. What we've said is, can we do better? Is there something that we can do even better than the system? And we think we've identified that. So we can take what we've been already doing and improve on it and make it better. Now, one of the things that has come to light is the HighValue service. So we are going to put through some mild restrictions now on electing to join the HighValue portfolio. If you're new and you're not sure what that is, because we've been a little bit, we haven't sent out as many new HighValue alerts recently because of this issue. And so we wanted to go through and make this clear and make these changes before we started sending out new HighValue alerts. And so what the HighValue is it came actually as a suggestion from our subscribers, because throughout the course of talking in insiders meeting, identifying trades, et cetera, there would be some that say, oh yeah, that's a nice looking triangle, but it's a really expensive stock. And so putting on a position there would violate our $500 of risk per alert sent out mandate. And some of our subscribers said, well, hey, if we have larger accounts, can't we still send out those alerts and let people that have larger accounts elect to take on those? And we thought, well, I don't see why not. That's a good suggestion. And we were surprised by the number of people that asked about it. Thought it would be a smaller number than it was. Well, what happened is with the number of people that signed up, we found out that a lot more people signed up than should have from following our guidelines. And here's one of the primary guidelines. We talked about this, is the fact that if you're trading all of our strategies, which means you're doing the hybrid, so you have the impulse and the volatility portfolios, and you elect the HighValue election on both of those portfolios, we said that for the HighValue portfolio should be $25,000 for each one. So that means if you had a $5,000 account for the impulse, $5,000 for the volatility, and $25,000 each for the two HighValue portfolios, you should have had a $60,000 account to elect the HighValue election. And turns out that a number of subscribers elected the HighValue portfolio, which didn't have that size of an account. So obviously, when we're putting on a HighValue position that ties up more capital initially, and then if that goes into the adjustment process, well, now we're really tying up a lot of capital. And so you're in the same spot, even though you might have had a little larger account than a $5,000 or $10,000 account, depending on whether you're in one of the individual portfolios or the hybrid. even if you had a larger account than that, if it wasn't large enough, you were still having the same problem of running out of buying power and not able to take on new adjustments or new trades. So in the end, it was causing the same problem that we've just talked about before. So we want to make sure that anyone that elects the high value is very clear on what the guidelines are for signing this up. So we had also a scenario where subscribers were having success, and the timing is everything, right? So we have this great run into the end of last year. We have a fantastic January, and everybody's making money, everybody's happy, and then people were electing that high value that didn't have sufficient capital, and that's victim of success, right? Things are going really well, everyone wants more, and so that timing played into it as well. So the way we're going to adjust this is we're going to have an application process. So if you ask us, say, hey, we want to elect the high value portfolios, we're going to send you out a notification that we want to make sure that you read and understand what the guidelines are, exactly how the high value portfolio works, and so that we know that you are aware of what the guidelines are for this election before moving forward. So we've also had people that came in that had that size of an account, but they were also, because their account size was larger, or at least the 60,000, were electing to do multiples of contracts. So instead of just following the exact number of contracts that are sent out in the alerts, they were doing multiples of them because they had a larger account. Well, if you're doing multiples of those and you're doing the high value, well, now you don't have enough capital to follow the guidelines anymore. So if you have an exactly a $60,000 account, you shouldn't be doing multiples of the contracts, only the amount of contracts that are coming out per alert. So all these things we've identified by talking with you, our subscribers, by listening to what you've sent in, by having our events where you've commented on these things throughout the event. So these are the issues. So what we've gone through is we've identified the issues. We've talked about what our past methodology is. So imagine you're probably like, all right, that's what's been going on. What's new? What are we getting ready to do? All right, here we go. Here are the changes that we're making. Number one, we are going to separate out anything that's viewed to be a speculative alert. Every now and then, we send out a position that's designed to be from the speculative side, which that momentum search, we had some success, we've had some losses. It's been a mixed bag with the momentum, but those are speculative positions. And what we mean by that is those aren't alerts that follow the exact criteria that are in my impulse search. So primarily the speculative trades have been in the impulse portfolio, but we want to make sure you're aware, hey, this is being sent out for reasons other than the normal guidelines that are the criteria for finding an impulse alert normally. Could be, we've had some that had really low extreme points on the CCI. So varying other situations that weren't necessarily in the full-fledged of the impulse strategy, some of the lower dollar ones, which are filtered out based on the guidelines of the impulse strategy, et cetera. So we want to make sure that you're aware that these are the speculative ones. They are alerts that go out and they're going to tie up some capital. So if you don't want those, you don't have to take them. It's going to be up to you. So it creates confusion in looking at trying to create what is the pure track record for the impulse portfolio. Well, if we're sprinkling in alerts that aren't from the criteria of the impulse portfolio, then it messes up the actual returns, whether it be to the good side or the bad side. But it's not a pure track record or result from the impulse portfolio if we're sprinkling in alerts that didn't come from the guidelines that are in that search. You've seen it and talked about it a lot of how to identify alerts for the impulse portfolio. So we're going to adjust the track record for the impulse portfolio for only positions that are from the impulse side. So if you're wondering, like, what are you talking about? Here's some examples of what would be viewed as speculative or hedge trades. So you can see the FUBO one, I noted in the commentary, this is a speculative alert. So this didn't come from the impulse side. And then the SPY positions to protect, that's a hedge. So that's not just a pure alert that's coming out. And we've had the SPYQ puts, those are hedges as well. So those were designed not just to be individual alerts, but they're there to protect the overall portfolio. So we're sending out a lot of bullish alerts. Well, what if the market goes through a significant correction, which could happen at any point in time? Well, we have those puts on as hedges. So they're not necessarily designed, oh, we think the market's going down. We've talked many times about the fact that you trade what the market is giving you, and the market direction has been to the upside. Well, we're so extended in the market could correct and correct significantly at any time. So we wanted to protect against that. We didn't have a lot of alerts out in the volatility portfolio as we did back in March of 2020 when the market tanked when COVID came out. We were in good position there because we had a lot of positions in the volatility portfolio that had a lot of long puts. Well, if you're not in that scenario, and we've been having less of our strangles on, then we have the puts as protection in the impulse portfolio. So that's not an impulse trade, that's a hedge trade. So, and then the NAVI was one directly from the momentum search. So again, we're going to send those out under the guise of speculative alerts. And then you can decide if you want to take those or not, knowing that, hey, this didn't come from the actual formula. Now, you don't have to do anything to elect it if you want it. All the subscribers are going to automatically have it. You don't have to do a thing. There's no additional cost, nothing like that. None of those things. It's just going to be a separate category. So when it comes out and you say, oh, that's on the speculative side, and maybe I'm just going to let that one go, or my buying power is a little light right now, I just won't take advantage of that one. But it's going to be completely your choice at that point in time. We're just going to highlight which ones are the different. And again, we will let you know if this is an impulse trade from that search or if it's a speculative trade. And so, as I mentioned, we're going to update the track record to show the difference between the two and keep the portfolios separate as designed and the way they're supposed to be. So the impulse portfolio, the track record will show only results from the impulse trades. And any of these other things that aren't impulse trades, they'll have their separate grouping, and that'll be, again, your choice as to whether or not you want to take advantage of those. So we're trying to simplify things down. We're trying to end the confusion. I know when one comes out and says it's speculative, it's like, well, does that mean I should put it on or not? Well, this is a forum where we're given the reasoning behind things and help you to make a determination on your own if that's something you want to take advantage of or not. All right, this one I think you're going to find really interesting. Revisions to the volatility strategy exit timing. This is where we collected a ton of data. So I think you're going to be pretty excited about this. This has been where a good deal of the challenges lie. That's what our research has shown, particularly over the last 12 months. What's been going on? Why has that been? Because I've been trading this strategy for a number of years. What has happened over the last 12 months to cause it to be a bit more challenging than moving forward? Well, the VIX has been higher, right? So we've had this elevated VIX creating the fact that the strangles are a bit more expensive. Well, normally, if you have an elevated VIX and the options are more expensive, you should have greater movement to go along with it, right? But that hasn't exactly been the way it's worked out. We've had these elevated IV, so elevated costs in the options, even going as far out as we do with our 25 to 30 delta, taking advantage of that delta curve as we do on the strangles. I mentioned this before. It's almost like the market makers are on to us now. You can go back and look historically when IV would fluctuate like this and the VIX, et cetera, it wouldn't carry down that far down the delta curve. It would be kind of focused more around the at the money options. Well, people are starting to figure out, we were one of the front runners. I really believe this. I honestly believe this on the math advantage of looking for a 25 to 30 delta. A lot of people talk about out of the money options now. They never talked about it before. It was in the money because you want the high delta, but you don't get the acceleration. Well, people have flipped. They're starting to figure all that out. So now that there's a lot more volume down at those deltas that we're looking at, guess what? The market makers are like, oh, we want a piece of that as well. So they pump up the IV and the options become more expensive down there. So again, victims of success or, spreading the word, letting people know. And, you've seen the spider web of when you have information that's good information and works and it gets out. There was a book written about it. A publisher came and wrote a book all about it. So that's been sent out everywhere. So the information is out. So in addition to the fact that the IV is higher, we've been having to wait longer for significant breakouts, or you have to wait for a more significant breakout. So two separate things there, but they kind of tie together. So if the options are more expensive, it means you need a bigger move. That's the gist of what we're trying to say there. So that means you got to wait a little bit longer for a longer move. And so then there comes time decay, right? Because on the strangle, time decay is enemy number one. We have a long call and a long put. So we have double the time decay impact on it. So if you're paying more for the options, meaning they need to break a little bit more, or the breakout needs to be a little stronger, which means you need to wait a little bit longer. See how all those things are tying together? So again, that's the problem. Identifying the problem, what's the solution? Pardon me. So here are the stats. Here's the math. And John, please feel free to jump in if I say anything wrong here, or you have anything to add, because as I said, he was very involved with the programming and the math at computerization that identified all this. So our average time in the trade grew from 48 to 74 days. There you go. There's that. What we were talking about is the trades are taking longer because we need a more significant move, or they're just taking longer to move because if you have the IV up and then it drops a little bit, well, then the IV comes down. That means there isn't going to be as volatile of a move. And so now that creates even more time that you have to wait for the breakout. So the statistics that we were looking at and we've been quoting are from history of how long I've been trading this strategy. Well, that's a significant increase in the amount of time. So what is that doing? It's chewing up time value, isn't it? So the fact that it's gone from 48 to 74 days on average, big difference. So these are the challenges that we've been facing over the past year, and I've talked about how the market's changed and pricing options has changed, and it's more challenging now than it's ever been. And I've been doing this, and you've heard me say this before, I'm just throwing it out there. I've been trading options for 25 years, and this is the most bizarre things I've seen that have come through as far as the pricing of options. You have to be really careful, which is also part of the reason I'm giving you a preface here of the new strategy, which takes advantage of that. So what do you do when you identify problems? I'm getting off course here. I'll get back on track. When you identify these issues, there's ways around it. You can always trade the way the market makers do because they're traders too. You can be just one of the sheep in the retail public and get caught by it, or you can adjust. And that's what we're doing. We're going to adjust and we're going to trade with the market makers. And there's ways to do that. And so we're going to take advantage of that. Now, look at this. The average profit loss trade dropped from 44 to 28%. So I've talked numerous times about the average profit is 30 to 70% in one of these strangles. And that's been the number since inception. And that's over 10 years. That's been the number. Well, it's dropped. Now it's down to 28% on average. And so that's a significant change as well. Trades closed dropped from an average of 36 a year to only 20 so far in 2021. So the number of opportunities aren't there. And I don't think I'm being any pickier on identifying the opportunities, perhaps a little bit on the pricing of the options, but not significantly. It's just there aren't as many opportunities, or there haven't been in this year. So does that mean the strategy doesn't work anymore? No, strategy is still valid. It's still profitable, but there's been additional capital required to maintain the current account and to stay in the alerts that have been sent out and with the adjustments. So again, another one of the issues. How can we fix that? Well, identifying all these things causes us to say, hey, we need to look deeper into this. There has to be a way to make this better. And so we did. We tore into the numbers. I've already given you a few there that those were easier to get. But when you see this, you're going to see, in fact, the amount of time that's gone into the data collection here, it was immense and a lot of data to collect here. So going through and taking a deeper dive, We did make some changes already. We played around with moving some of the strikes around. You've heard me talk about that in some of the insiders meetings, where we went from slightly higher delta, a little closer to at the money. We even went in the money at times, especially with the momentum trades, because they were really attacking those. That was where all the retail public was in the lower dollar stocks, right? With all the hoopla that was going on from chat rooms and tweeting memes back and forth, the meme stocks, etc. That was creating a great interest in lower dollar stocks. So, man, the market makers came after those in a big way. And it was really challenging in order to find which way to go. So some of those created a little bit better results, some of those changes that we made, but we still feel that there's more improvement that can be made by making some other changes, which we're going to show you here in just a second. So here's a detailed analysis of closing the trades without the adjustments. So this would have showed you if we just put the trade on without the adjustments. We've gone through and created all this analysis. So let's take a look. So here we have, looks like a risk graph, doesn't it? It looks very similar to a risk graph, and then in kind of a way it is, but this graph here where the horizontal axis here represents the amount of time in the trade. Now, this is not hypothetical. These are our actual trades. We took apart every one of the trades, went through every single one of the trades since inception of LE Wave options and put the data on here. So I just want to make sure that you're aware, these are not projections. This is not, if we make this change, here's what, this is the actual data from the trades that have been sent out. So there's no speculation, etc. This is the number. These are the facts of way that things have turned out. So I think you're going to find that to be quite interesting as we go through it. So on the vertical axis, that's the average trade return on investment. So again, the horizontal axis, the amount of time in the trade, the vertical axis represents the return. So when we go through and look at these numbers, you can see that here's the average return on the volatility strategy on or before nominated time in trade. So if we take a look at this line, you can see that the pricing is done at the real prices, etc. So this is the real data. And if you take a look at this, you can note that immediately, we've highlighted this before. We even talk about this in our new subscriber call. The fact that because we're buying a call and buying a put, day one, position is going to be at a loss unless you get a big breakout the first day. Well, there you go. There's the evidence of it. Immediately, day one, the position is below the zero line. So we're showing a loss. Remember, the vertical axis is the average return on investment. Now, here's where the data gets really interesting. The maximum average return on investment happens at, if you draw a line with your eyes down, you can see at 31 days. But then you go over and look at 21 days, it's almost the same spot. It's a little bit higher by actual math at 31 days, meaning the profit was realized, the maximum profit was realized at 31 days as far as the time. So profit to time, remember, so this is taking into account the time in the trade. In other words, we did almost as much average profit in 21 days as the peak that was shown at 31 days. So why wait that extra day, the extra 10 days? Because you can see this little dip here that occurred between the 21 and 31. It did blip back up, but is it worth that additional little drop there to stay 10 more days when the return is only a tiny bit or a fraction higher? It doesn't really make sense to do that. So this is where it gets really cool. So this is a, this is a computerization. So the computer took this and created a smoothing effect, if you will, the ideal smoothing effect of the actual data. So all the data there, it's kind of like a moving average. You know, you create the smoothing line with the moving average, etc. This is what the computer did to show this is how the curve looks for the profit. So there's that max profit at 31 days, just a little smidgen more than at 21. Now look as we continue to go through the number of days. And this is where it gets really interesting. So please, if you haven't paid a lot of attention yet, watch this now, because there's two halves to this, what I'm going to share with you. Once we start getting past that 31 days, you can see the average return starts to come down. So we're actually losing some of the gain that we had. And then we start to get out to the 73 days or so, and it goes back up. The return starts to go back up. Now, this is the math that goes with what I've been trying to explain over the past couple of years on the methodology of if you hold the position, so what the average is like 90 days of putting one of these on. So as we're starting to get towards that 90-day frame, if we have some that move towards expiration, because the delta and gamma work in our favor, the average return curve moves back to the upside. So where we were seeing gains on those positions that had been losses all the way up to the very end. And in addition to that, that's where some of the adjustments came in, and some adjustments that had come in and helped mitigate losses or turn losing positions into winning ones. So there's the mathematical proof of the methodology that we've been doing, showing you the fact that, hey, if you hold it towards that last point in time and expiration, it doesn't make sense to roll it out ahead of time. You don't want to do that because you're just dumping in a whole bunch more time that you're going to lose in time decay, and you're starting to get delta and gamma in your favor. So it made no sense to do that. So there's the visual depiction. There's the actual math that shows that on how that would work. But I can say that, hey, there's the justification of what I've been telling you about the methodology, showing you this is the reason why we do this. But that doesn't solve the problem of you're in this trade 90 days, and even with this curve back to the upside, we haven't eclipsed that maximum average return that was back at 31 days. So waiting to see if we were going to get a better return, okay, it was helpful, better than closing out at 69, 70 days, but it's not worth it in the end when you see that it really wasn't making a significant difference. It would have had to have been a significant high or movement higher on the average return on investment. So what we can do is offset this amount of time that your capital is being tied up by taking advantage of what all this data has shown us and starting to get in and out more quickly. So now we won't be tied up. We won't have the capital tied up for that long. You're not going to see positions go to expiration in the volatility strategy anymore. And that's going to take that psychological thing away. And also, we're going to maximize what the math is clearly showing us. So when you start to look at all the years, so we're putting all the different years here, same thing, return on investment against time. So these are all the years that we've been in existence. What do you start to see initially? This to me was eye-opening, and understanding, the commitment to the math, the Greeks, etc. But you can't ignore this. And when you look at that, you can see what is the common theme over all of the years that we've been in existence. When we're putting on these triangles in the volatility strategy, look how tight the lines are. All the years are almost the same. So the data is clearly showing us that the best time for these is that first 21 days. Look how tight that is in that ascending channel. That's ideal. And so again, as I said, having all this breakdown and all this data is it's going to make everything better in the long run, and was really eye-opening to me. So then we go through this next segment of time. Well, it wasn't too great of a separation, but note the angle of the channel. Was there any great advantage of holding it to 45 days? What happens at 45 days? Well, if we put on a position 90 days out, 45 days is the key as far as when time decay really kicks in. And look what happened after that. We're all over the map as far as the difference between the return with the longer time in trade. So the volatility in the position becomes crazy, but the tightest window is showing that profit moving up in the first 21 days, meaning that if we just close the position out, there's very little variance on the profit, low volatility of returns. And then that middle segment, there was a little more volatility that, had we had a higher return in there than just a touch above the 21 days, perhaps we could have justified that. But then you look at this craziness of the high volatility towards the end, even with that curve starting to come back up, the fact that it doesn't eclipse the average return means that we don't really need to do that anymore. So this has been just really cool stuff to have and show you the actual math involved. So there we go. There's the high point there at 21 days with the end of that channel. Now, what that is doing is showing a net return of all the positions. Okay, so remember, this is all the positions. The net return is 11%. So that's lower than what we've been talking about from 30 to 70%, right? But we've already identified the fact that that's come down. But with a net 11% return in 21 days, if we were fully invested, that annualizes out at 191% return on investment. So just 11% annualized out. Now, it says if fully invested. So I want to highlight that for you. That means that if we had our full stable of strangles on it, meaning that our $5,000 account within the volatility portfolio was all being used, all on position. So we're fully invested. So we're rarely fully invested, right? So the returns in honesty and fairness are going to be less than that, likely in realizing that, because we go back and look, there are not that many times where the entire account value is being used. So we're not fully invested. But if we were, and who knows, with this new data and the new methodology, with the fact that we're going to be in and out of trades more often, perhaps we go through in a time when we have more candidates. And if that happens, we get out of 2021 and we start to see the more normal amount of candidates, perhaps we do get to a point where we're fully invested. But historically, we haven't been. But that shows you the capability of this exact system that we're going to be moving to now. So if we are fully invested and we're generating a net 11% return for each of the alerts, then that could annualize out really, really well. All right, so let's take this data and now start to look at the performance of profits and time in the portfolio return on the percentage of average winners. So there you go. There's that yellow line showing you the fact that it was averaging up in that 40 to 60 range. So that's where we were. But notice what happens here. Let me go back here. Notice what happens past that 21-day window. You look at that. Did it give us any greater return? This is really similar to what we just showed as far as that maximum gain being technically at 31 days, but really close at 21 days. But holding it past that, did that do anything significant to that average return over there on the 40 to 50%? No, it doesn't. So for the percentage of winners, it doesn't change things. And then when you look at the losers, the percentage of losers drops off dramatically after the 21 days. So holding it past 21 days doesn't increase our percentage of winners, and waiting past the 21 days significantly increases the percentage of losers. So again, that's actual data from our, you can imagine the amount of time that went into this. I hope you appreciate the amount of time that went into this, because we had to go through the data of every single one of those past alerts to create this. So the percentage of winners doesn't really give you any benefit. It doesn't go up at all to hold them longer, but then your percentage of losers becomes more significant. So what does that do to the bottom line as far as returns? Then obviously it's going to be an effect on the returns. All right, so all that's great, right? All of the data that we've showed you so far is really good. Is there a downside? Well, in a way there is, but it's just perception. So here comes that psychology again. So here's the perception. When we take a look at this, and this is the percentage of winners again, you look over on the right-hand side and you can see that, wow, we had a pretty good percentage of winners. That's the tan area there on the shaded graph. And we've been really proud of our track record on our percentage of winners. It's been really good. But holding the positions that long, we've already gone through all the negatives that go along with that. Holding the positions longer, going through the adjustment process, we are able in time to turn a lot of losers into winners or to recover losses. And our percentage of accuracy becomes much better. But at what cost? Well, you've shared with us, and we've determined from all this data that the cost is it's tying up your buying power. And if it ties up your buying power, then you don't have the buying power to enter the new trades. Same thing that I talked about in the beginning. Now, for some people that have larger accounts or have been around for a while and have realized gains over the years, this isn't really an issue for them. But we have new people coming on all the time. And so what we're trying to do is make this better, not just for the new people. I want to highlight this. If you have a larger account and you're like, I don't run out of buying power, etc., this is still helpful for you because we're going to be getting in and out of trades more often. Hopefully there'll be more candidates available. And when we have that return, we get in, we take the return or take a small loss and move on. And we keep going through and creating more. Now, there would have been a time, wouldn't there? There would have been a time in the past where you could have argued that, well, the downside of this is commissions. Now you're going to have to figure out commissions, but we don't have that problem anymore, right? I mean, commissions are nothing these days. I've talked before, when I first started trading options, it was $100 in and $100 out. That's what I paid when I first started trading. Can you imagine that? That's what it paid for commission. So it's really not an issue anymore, but the net of having a net 11% gain on every single position, taking into account the losses, etc., it's worth it to go through that. And again, commissions aren't an issue. But what we're wanting to highlight for you is our percentage of winners is going to come down. So if we're going to close these positions off or start to really watch them close for management at around the 21 days, we're going to have a lower percentage of accuracy or a lower percentage of winners. So you're going to see more losing trades. Now, the data has shown the losses will be small. So we're not going to have any of those big losses that need to be recovered. We're not going to have positions going to expiration. We're not going to have any of those things. But the trade-off is the percentage of winners is going to be less. So I want to make sure everybody's aware of that, because they're like, oh man, there's more losing trades than there used to be. I'm not used to this. Well, this is the offset of that. But in the end, you still are making more money. You're not tying up as much buying power, and you have the ability to take on more alerts because your buying power is not tied up. So on average here, you're going to be looking at about 40% winners versus 80%. So pretty much this is cutting our number of winning trades in half. So that's the offset of it. It's nice to say, hey, we 80% winners in our volatility strategy. We won't be able to say that anymore, but if we continue to make these smaller gains and move forward, that in the end is better, right? If you have buying power that you can take on more alerts, and we're getting into these, and you might be taking smaller gains, but you're getting more gains or getting them more often, then the trade out over time will be the fact that you make more money, you don't lose your account buying power, and everybody's equity curve goes up. And that's the whole idea. So I just wanted to spend a couple minutes to make you all aware of that that's the trade-off side. So in summary, what we'll start looking to do is exit all these open strangles that come out in the volatility strategy at around that 21-day mark. Now, obviously, we'll take weekends, holidays, etc., non-trading days into account there. So it's not going to be just a hard, fast 21-day rule, but it's going to be pretty close to that, somewhere in that range. So they get in, they break out. I mean, the data is clear. There's a tight window of profit that moves up in that first 21 days. So we're going to take advantage of that. And if it hasn't, then we're not going to wait, give it more time for the breakout. What this is going to do, now here's what happens. You've heard me talk about this a lot. It doesn't mean that these strangles don't break out. What happens is when you get a triangle, sometimes that triangle forms a larger one, right? We've seen that. We're seeing that right now in CWH. Sometimes a smaller triangle forms a larger triangle, and that takes more time. So we're not going to be waiting for those to have, we're going to give it this time frame, break out or don't break out, we're moving on. And so we're going to keep that buying power free in your account and not tied up. So any profitable trades at 21 days, we'll watch those pretty closely. Are we in a move that looks like it continue for a day or two? Well, we might give it that extra day or two. So again, it's not going to be just a hard, fast 21 days, boom, we're out, but right around there. So we'll do the best to manage that time frame to the maximum profit that we can get in that area. And again, it looks like the winning trades will move down to about 40%. But if you're still netting a 11% gain, taking into account the fact that you only have 40% winners, do you really care? I mean, the percentage of winners is great for posting it on the website and patting yourself on the back, etc. But in the end, what we want is everybody's account to grow. We want everybody's equity to move to the upside. And so, hey, if we're not getting 80% winning trades anymore, but everybody's making more money, that's a really acceptable trade-off. And then we take away the psychology, the frustration of being in trades for so long, the frustration of having trades go to expiration, the frustration of sometimes trades sit there open for a time before it's time to get back in. All that stuff, the things that have bothered everybody is going to go away. So we won't have that anymore. So we're really excited about this data because it verifies, number one, the strategy still works, the strategy is still viable, and what we can do is make it a shorter term in there and benefit everybody in the long run. So again, I want to highlight the fact that if you have a larger account, I want you to feel like, hey, well, this hasn't been an issue for us. The fact that you're going to be getting more gains, this kind of, to me, goes to the turnover thing, like the Walmart model, right? Where I think this is a really good analogy where you can sell premium products, but then if you sell at a discount and you sell more and you turn your inventory faster, in the end, you end up making more money. That's why Walmart works. That's why discounters work. They take a less profit percentage on each item, but they sell more items. And in the end, they make more money. And that was kind of why I put that into going back to my golf career. I owned a golf shop at the time and did the same thing. Golf often is known to have great markups because golf's an expensive sport. So it's usually being played by people with money. And so everyone in the area where my golf shop was hated me because I didn't mark stuff up like everybody else did. So guess where everybody came to go shopping? So it's the same type of thing. I think that makes sense. So you turn the portfolio over more often, even though each return is slightly less. In the end, the return on the account is bigger and the account grows faster. So hopefully that analogy made sense. I think it does. All right, so there we go there. Now, the new strategy. I know everybody's really excited to see this, and man, this really ties in. So I can't wait to give you what's really cool about this new income generating strategy. We're going to launch it in December, and I wish everybody could see the amount of time that's being put in behind the scenes, not just looking at alerts throughout the day, not just doing Trade Finder and doing the insiders meeting on Thursday and then our educational series. There's so much more going on. People have literally been working around the clock on all this data. So at the same time we were collecting all that data on the volatility strategy on ways that we could make it better, improve it, we've also been going through and collecting all this data on the time strategy, and the results they're just off the charts. I mean, it's really amazing. So basically what the new income strategy is designed to do is complement the existing strategies by profiting on sideways move. We haven't had that, have we? We've had the impulse, which is a directional portfolio looking for stocks that are moving up or down. And then we've had the volatility strategy, which profits, it still has to move, right? So even though the stock is going sideways and consolidating, we don't profit off that. We profit when it breaks out to the upside or the downside. So it still has to move directionally. We've been missing the piece that profits when a stock stays sideways. So guess what's been going on with the market, right? So all this churning, all this money that keeps spinning around, we keep talking about reallocation and how the money changes into different strategies, market rotation, if you will. They're churning all of this. And that's what we've been experiencing with holding our strangles longer. So we're going to get away from that now. We won't have that effect. But how can we take advantage of that? Well, you want to have an option that you're selling that takes advantage of that. So that's what our income strategy, our time strategy is going to be. We're going to be selling a shorter term option that's going to benefit from that churn that's been going on. And then we're going to protect it with a long option. So we now benefit from time decay and IV. So kind of it's almost like a butterfly, which is one of the strategies that will be utilized in this, in the fact that if you start with high implied volatility and it goes down, that's okay. And if the volatility goes up, depending on where the stock is, that can be okay too. Same thing here. But what we are expecting by the way we're doing this is that we start with higher implied volatility and it drops down. So we're going to benefit from the drop in IV, but time decay is a definite. That is going to happen. And because we're selling a shorter term option, we're going to be selling it when time decay is maximum. So we're going to profit from an elevated IV at the time and the maximum time decay, and we're going to protect it with a long option. And so this is going to help you by creating more capital. It's an income strategy. Now, I want to make sure that I'm clear on this as well. It's an income strategy, so it's not going to be, you're not going to see home runs. Like if we are in the impulse strategy and we get a directional move, we can make a lot of money in a short period of time, right? If you get the direction right and it happens in a reasonable time, you have the potential to make big returns. There's no potential for those kind of massive returns here, but what there is really consistent profits with little drawdown, little to any drawdown. The charts that we're showing you is very remote. So we're creating this income. So think of how this plays in now with the volatility strategy. So we have the volatility strategy where we're going to profit on a break and we're going to be in short term, like 21 days or so, which happens to be around the same time frame that this has been showing that you get a nice return on the income side. So what we're showing you is a new strategy that's going to be shorter term. The volatility strategy is going to be shorter term. So we're going to have a number of ways to generate good income streams with this will have a much higher percentage of accuracy than the volatility does, but still the net return already went through the turnover analogy, et cetera. So we're going to have shorter term positions where we don't care if the stock goes up or down. And if it stays sideways, that's great too. So this is really cool. We can't wait to introduce this to you. And I'm just going to leave you with that tease for now, because we will do another event like this when we launch it and go through the complete details. So that's just an outline of it. More to come when we actually do release it. So watch for that in the not too distant future. So to summarize, what we've covered this evening is we're going to restrict the high value service in sending you out a notification, and we want you to make sure that you read it and sign it so that we know you are clearly aware of what the high value strategy is and if you choose to do it or not. So there's no misunderstandings or miscommunications there. Separation of speculative and impulse strategy trades, so that if you see one come out that's on the speculative side, you can choose to take it or not. If you're a big believer in Elliott wave and the zigzags and all that stuff, and that's where you want to stay, great. Now you have the opportunity to make your choice to say, I don't want those. Or if you want to take them, you can. We're revising the time and trade in the volatility strategy. Again, we're not changing the strategy at all. The strategy remains the same. All we're changing is the amount of time that we're going to commit to each one of those strangles. We're going to give a shorter term time to break out, and that's it. But the new time strategy will be coming out in the not too distant future as well. So I think you can see the excitement of the potential growth in portfolios with some of these quick moving positions coming in and out, even though they're not massive gains, but you start to tack on a lot of smaller gains, then you know what happens in your portfolio at the end. So at this point in time, John, I'll open it up. I imagine there's some questions regarding all this. I'm sure you've probably been feeling some as well back there, but happy to take any questions regarding any of the two. I would ask that you don't get too detailed in asking about the income strategy, because as I mentioned, we will be doing one of these sessions. We'll go through it in detail. So I don't really want to go into any more detail other than giving you those basics on the outline. We'll give you the ins and outs as soon as it's released. So if we could kind of hold them. I mean, if they're general questions, great, but questions more specifically designed to any of the data that we've shown or the methodology that's going to be changing, what we're doing moving forward, et cetera. Love to have those questions.
Okay, thanks, Rob. Yeah, look, there's plenty of questions. And just before we go on, I'll also pass on to you that there's a lot of people who are expressing, great happiness with or let's say excitedness about what we're going to be doing going forward. So I just thought I'd pass that on. I think people are really appreciating the work that's been done and the fact that you're prepared to, review everything and try and lead to a better outcome. So well done.
Well, thanks. I appreciate that. And was hoping that the people would be excited about this, because we are. We're excited about it as well. As I said, that some of that I knew, but some of the data was pretty eye-opening to me. So, hey, if we don't continue to grow, you're just standing still. We don't want to do that. So we want to continue to get better.
And just on that new strategy, without getting into details, people were just asking about costs. And I think it's safe to say that if you're an existing subscriber, you'll receive the new time strategy at no additional charge.
Yes, that's correct. Yeah, I neglected to say that. So thanks for filling in on that. All right. So if you're already an existing subscriber, then it comes with it. So excitement about that.
And then
no additional cost to you. So
the other questions that were coming in that were just in relation to the strategies. So you already mentioned butterflies, and people were just asking if there's calendar spreads in there. And I know the answer is yes to that as well.
There's, again, I try not to get into too much detail, but I promise you we'll cover all this, but it's a combination of diagonals, calendars, and butterflies, and there's criteria for which is best at which given time. We'll cover all that when we go through it, but they're all strategies that are designed to capture that IV and time decay on a short-term basis. Oh, and for those of you that may be interested in this, yes, I'm just telling you that I wasn't going to go into detail, and I'm here and throwing this out, but I think this will be exciting to some people. Is when the weekly options are priced right, we can take advantage of those as well. So there's just so much data, and in addition to that, the search that we're going to be using is an AI-based search. It's just the way of the future, isn't it? Technology. And so it's the general guidelines. If you want to know how this works, the general guidelines were a system that I've traded ever since I started learning about options and figured out a way to take advantage of IV spikes. But the computers have taken it, and you know how AI works, right? It just feeds on itself and it goes on. And so all of that has made the system incredibly impressive. So I'm done. I'm not going to talk about it anymore.
No problem at all.
Just the tease there.
No problem at all. So moving back to the bulk of the questions are obviously on the updates to the volatility strategy. And one thing I just wanted to see if you wouldn't mind moving back to those charts where you were talking about the percentage winning and percentage losing trades. I think you misspoke a couple of times, and I just wanted to mention the yellow line at the top there is the average percentage winning trade, not the number of winners, and the red line is the average percentage losing trade. So just to be clear on that, I think when you were referring to it, you were running through quickly and you may have just made that reference incorrectly.
Oh, okay. If I did, then thanks for clearing that up.
And so I guess the point there being that, as you said, the average winning trade pretty quickly gets up to around 60% and more or less stays there. It doesn't get any bigger. But then the average percentage losing trade obviously gets bigger the longer that time goes on. And so that was the point. There was just a couple of questions to clarify that. So, again, feel free to ask any other questions if you've got them. But that's what the point that Rob was making. Then
yeah, thanks for clearing that up,
Rob. And Mike and Graham, a number of people have asked, does the fact that you'll be getting out of the trades more quickly mean that you will take shorter dated options? In other words, rather than 90 day expiration, 45 to 60?
Not necessarily, because then we're going to we'll have more time decay, right? So if we started looking at shorter term options, maybe what I always tried to do is, if we were right on the cusp of nearing that 90 days, would give it a little extra time. So perhaps on this one, we will go down one less, but we got to be careful here that we don't just, I assume the question is to make them cheaper. I'm not going as far out, but if we start putting them on where time decay is maximum, then that data that we showed is inaccurate, right? Because part of that return is being generated because in the beginning, there's not a lot of time decay. There's a little, but not a lot. And then over time decay becomes more significant. So there isn't going to be a great difference in how far out in time we go. I'm glad you asked this question, because I probably should have said that when we go through on the methodology. But no, there's not going to be much of a difference in the amount of time, because we still have to stay in that area where time decay is not a significant enemy. And I think by capitalizing on this 21 to 31 day window that we identified as, hey, that's the sweet spot, then it enhances that return. And if we were to use shorter term months, then that data wouldn't be accurate. So now we need to stay with what the math was showing us. So thanks for letting me clarify that as well.
Thanks, Rob. And a number of questions also. I think people just wanting to clarify exactly.
Well, let me ask. I'm sorry, but let me, because I'm making an assumption on that's the thing with writing in questions. I'm sorry to interrupt you, John, but I'm wondering if they were asking that because of talking about how Delta and Gamma are our friends in the last 30 days. And if we're only going to be holding it 21 days, might we put on a position only 30 days out to enhance the Delta Gamma move that we already get from the 25 Delta by being in a frame where there's not a lot of time decay. So I think I'm going to backtrack on my answer and say there could be times based on how much theta is left where perhaps there is a shorter term option used, but that would have to be a scenario where there wasn't, because when you're building, the reason people use weekly options is because they built in a full week of time value. And if you had a month option of time value and you only have a week left, you have less time value left in that than you would have if you bought a weekly option, right? Do you understand what I'm saying? That if you bought a weekly option, you have an X amount of time value in there, theta. But if you bought a monthly option and 3 weeks have gone by and you only have a week left, you're going to have less theta left there than you would if you just bought the weekly. I know that's counterintuitive and it shouldn't be that way, but it's not linear, right? Nothing is linear in the world of trading. So if there was a scenario where for whatever reason they had already taken a lot of theta out, I'm just going to say I'm holding the chance that there could be one. So I don't want to say no, it's never going to happen. On further thought of where I think the question might have been coming from, which is different than what I thought initially, there could be an opportunity there, but it wouldn't be a significant number that we would do that on. So anyway, I felt like I should give a more detailed answer on that. It just thought popped in of, oh, maybe that's where the question was coming from.
Well, actually, you were right. There was people coming at it from both. So some people were talking about the cost of the options, and there was a couple that were referring to Delta. So I think you covered it well. So,
okay, so I got both sides of it then.
You got it, exactly. And then there's another question / comment from Valisha, which I think is an interesting one. He's saying, I get the 21-day exit plan for losing trades, but if the trade's losing 50% plus in 10 days, we will get crushed in volatile markets. Do we need a mad percentage loss, a max percentage loss for rule? And as you know, hard to rebound with options at the level of the decline, requiring lots of adjustments, etc. So I think the point being that you are looking at the chart on the screen, actually, you can see that the average loss at 10 days looks like it's about 10%. And I guess you can talk to this, Rob, but the fact that there's a put and a call means that the likelihood of having that kind of large percentage loss within the first couple of weeks is highly unlikely, because the market would have to move in one direction or the other, and therefore the strangle would make money.
Correct. Yeah, I was going to say, and you're right. The chart on the screen is perfect to illustrate that. You can see where a 50% loss comes in at 49 or 50. It's mathematically, I understand the question, but it's mathematically impossible to have a 50% loss in 10 days in a strangle, unless we violated our rules. The only way that could happen is if you bought options on a massive volatility spike and you way overspent, and we don't do that. Part of our criteria is making sure that we avoid high IV. Part of the formula is the IV needs to be low, the ADX needs to be low, all those things. So the only way a 50% loss in 10 days could ever happen is if we violated our criteria, which we're not going to do. So with our system of checks and balances, with the criteria that go into selecting those, it's mathematically impossible to have a 50% loss in 10 days. But I understand the question, but feel comfortable that that isn't going to be an issue. And there's the proof right there in that red line.
And Chris is asking, he's saying this may be what AI means, but is this analysis based on back testing existing trades? So same entry every time, exit them 21 days later, because judging the entry timing is key to timing of the impact of moves in the market.
Well, yeah, it's based on all the actual trades that were sent out. So yeah, there's no projections. There's no, this is the actual data. So it was taken from exactly when the trades were put in. So this is real. And there's nothing has been assumed. Nothing has been projected. This came from the, I mean, this is the purest of data you could have. This is from the actual alerts. So when they were sent out, et cetera, it's the real data.
Thanks, Rob. And Al's just asking, he noticed that with longer running triangles also explode slower. Therefore, the previous guideline was no longer than 4 to 6 months. With this new change, will the triangle time length change? So I think he's talking about the actual size of the triangle pattern. Will that be adjusted at all, given the shorter time frame?
We're still going to stay with looking for that 10% move. So not much of an adjustment. You're right. The larger triangles, they take, usually the move ends up being bigger in the long run, but it takes longer because when you have a really big triangle, the breakout's not quite as volatile. I've talked about this before, how usually in the long run, in the end, it does well. But we're not going to be in that scenario anymore. So not going to necessarily look for smaller triangles, because we still have to stay with the math, right? We still have to stay with the delta and the gamma, and where it works best is when we're in that close to 10%. It doesn't have to be exactly 10%, but not much less than that potential 10% breakout from the mouth of the triangle. So that'll stay pretty much intact. And again, that's, staying with the data that we have here. So we have to, interesting questions that are coming up, but I think it's important that everybody notes that this data has come from the way we've done things. So if we change the methodology, this data is no longer accurate. And then we're like, okay, we're trial by fire then. And so we don't want to do that. So we're going to follow all the same rules, all the same system, et cetera. The only thing we're doing is realizing that, hey, the data has shown over years that you get a pretty good return in 21 days. You could get a tiny bit more if you stay 31 days, but then you're adding a little risk in between there on some. And so that movement to the upside, we're just going to hope now. What would be the fly in the ointment here is if they're just not any strangles, right? That's the only negative otherwise to my scenario of, turning the portfolio. And we've already gone through a year where we've had fewer, you saw the data, than normal. And so I think we're likely to move out of that scenario where there aren't as many. I think we're going to have a ton of them coming up next year, because this has been one weird year. I mean, 2021 has been, if not one of the most challenging years I've seen in the world of options trading since I started. It's just been, man, you see stuff and you're scratching your head, and then you're fighting. Okay, how do we take advantage of it? Because anytime there's a problem or an issue, there's a methodology to take advantage of it, because the market makers they're not losing. I promise you that.
Yeah, thanks, Robin. Al was just saying he just realized another benefit to this could be that it makes it easier to dance around earnings also.
Good point. Yes, absolutely.
I noticed that Kev has his hand up, I think potentially for a voice question. We're probably happy to take that, are we, Rob?
Yeah, sure.
All right. So, Kev, if you've got a voice question, leave your hand up and I'll come back to you in just a moment. Sean was just saying, do you have dollars attached to the rates, the average loss and the average gain? And I can tell you from constructing the data, we don't have dollars. It's been done on a percentage basis, but the chart that Rob has on the screen there, if you look at that 21-day mark, you can see that the average profit in a trade is just under 60%. It's, I think, about 58, 59%. And the average loser is about 16%. So it's not dollar terms, but hopefully that gives you relative terms that you're looking for. And then the next question was from Donald. He says, is the reason for taking data back to 2019 due to the change that took place in the VIX, which was higher, lower range for the VIX?
No, we just wanted to go from, and the VIX has been lower, the VIX has been higher. I think, in that computerization smoothing, that kind of it balances out over time. It's just we wanted the maximum amount of data, so we just went back to inception. So basically, that's the reason going back that far. We just wanted all the data we had. And feel free to say anything if you want to add anything in there, John. But
no, I think that's what, from my point of view, what you said is perfectly correct. That the new system that you had since 2019, where it's collecting all the mark-to-market data on a day-to-day basis, means that we're able to go back and interrogate every day in real trades. And so that was the data that we had, which made it available. So yeah, exactly right. So look, Kev's still got his hand up, so I'm going to unmute Kev. And Kev, if you wanted to unmute from your end, you should be able to go ahead and ask your question.
Hi, Rob and John. First, the comments to both of you. First of all, thanks for all the analysis and the detail, etc. It's great. Actually, we're just starting to touch on my question, John. My understanding is the data refresh will be picking up, the closing midpoints on the respective days throughout all those trades. Now, my understanding and my citing of it is that the bid-ask spreads are artificially wide at the close, and I think Rob has mentioned this on a number of occasions himself. So I'm just wondering, are you comfortable that data is, I think it's the best you're going to have, but there is that artificial spread, particularly if it's out of the money strikes, and there's sometimes big variations there. Now, I know you're going to take a midpoint between the bid and the ask, but what are your thoughts on that?
Do you want me to take that one, Rob, or would you like to answer?
No, go ahead.
My thoughts on that one, Kev, are that most of the data is pretty accurate. There's no doubt that there's a few spurious, big, wide spreads, but we felt that there wasn't any value in trying to adjust the data. And in fact, what I believe that it means is not only for the spread reason, but also for the fact that I'll say it's just a dumb entry. In other words, there was no kind of additional intelligence to look at the market on that day and make any trading type decision around exiting. So I believe that when Rob is doing this on a day-to-day basis, you probably see that he can improve upon these results, because he's not just going to make a dumb entry 21 days. He's going to be managing it. So I think it's conservative, would be my short answer to that. I don't think there's any great extra amount of beta that's been captured there in any way, shape, or form. Hopefully that makes sense.
That makes sense, yeah.
Sorry, I'm sorry, Kev, go ahead.
No, I can understand what you're saying there, and that does make sense to me for sure.
Okay. And if I could add something, I mean, you're totally right. We've talked about this numerous times. We've seen it, right, when some of the spreads are extraordinarily wide after hours, but that tends to be with more volatile stocks. And when we're looking at the triangles and the strangle formations, it tends to be when, they have lower volatility, right? Sometimes we get volatile breakouts, but we're dealing with stocks that aren't quite volatile. They've been going through consolidation, and IV has been compressed, and the ADX is low. So I think there would be less of that wiggling around after hours in the strangle portfolio than there would be in any other one that we would have. So I would second what John said, that I believe the data to be pretty spot on.
And Rob, George was just asking if you could review the winners and losers. So maybe that last slide that you were showing in this section, just to reiterate the fact that you are anticipating around a 40% winning ratio.
Right here. This is the slide we're talking about.
Yes.
Yeah, well, it basically just gives you the actual data on showing where we would be. And you can see that peak at the 21 days with that white dotted line. And then when you look over and see the percentage of returns, it's just under 40%, right at, I believe it's 39% is the actual number. But I want to go back to my retail analogy of not getting caught up in the fact that 40% winners and 60% losers, that doesn't seem like a system that's going to work. But remember what John just showed about the disparity between the winners and the losers on that graph that we were just on. That's where the profit comes in. And even though the net profit is a little bit less because of where we are, but we're turning the portfolio faster. So in the end, you make more money. So it is kind of like, mark up the Garmin as much, but you turn it over 2 or 3 times versus one that has a big markup. In the end, you end up making more money. So it's just, it is something that we wanted you to be aware of, hey, there's more losses coming through than what we're used to. But in the end, when we look back over the next year after doing this, I think everybody's going to be really happy with where their accounts look, and you're not going to have the issue of running out of buying power, because we're going to be in and out so fast, and you won't have capital tied up in a long position, et cetera, where you're missing out on other trades. So not only are you in and out quicker, but you're in and out with a net gain on average. I mean, the numbers are the numbers. So the system looks great over time. And 191%, that looks fantastic. But again, fully invested, we're not always fully invested. So bring that number down. But regardless of whether you cut that number in half, that's still a great year, right? So we're really excited about this. So we just wanted you to be aware that's a side effect of it. But in the end, looking at this data, I'll take it every time. I think one of the things that I wanted to add is, I've been trading this for a very long time. I think over 12 years ago is when I first created this and thought of how can we take advantage of the delta curve. And I never took the time to go through and create the kind of data that's been crunched here. And so I start thinking back of how much, what difference could that have made for me in my own trading if I'd have been doing this from the beginning. And so we're really excited about, how this is going to positively affect people's profits and the growth in their portfolios. And so I think back, and that's the first thing that comes to my mind is, we didn't have the technology quite as great as we do now 10 years ago. I mean, it doesn't sound like it was that long ago, but technology changes every year. So I wish I would have had this data back then. So I'm as excited, I hope, as all you guys are.
Thanks, Robert. Look, there's a few other questions from people that are going further afield and onto Profit Source and the new system and leaps and all sorts of things. But I think in terms of questions related to what you've spoken about tonight, we've probably addressed everything. And we can probably just say to the people with questions on the new strategy, etc. I know early in December you've got a presentation planned, and we'll catch up and answer all those questions then.
Yeah, absolutely. And just to second what you said. Yeah, we will be going through a presentation on the new strategy in detail. And so I think we'll answer everybody's questions there. I know you're curious. I know you're excited about it. We're now covering every potential market scenario, right? Which we haven't done before, up, down, sideways, or breakout. Anything the market can do, we're going to be there, and we're doing it with some really cool strategies. And then updating this volatility strategy, I'm super excited about that, when you don't have to pick a direction. And so we don't have to pick a direction, or we get one covered sideways, which is this AI system. It's just super exciting there. For the rest of the questions, we'll take those tomorrow night in the insiders meeting. And don't forget, we're talking to you again tomorrow night. So for the rest of the stuff along those lines, then we'll go through that. We just wanted to make this a nice tight session. I just cannot stay on time. We wanted to make this an hour or less, but we do want to get all your questions, et cetera. I was talking fast to try to compress this down, but get the information out to you. But you came up with some insightful questions, as you always do. And from what John said, I think the overall mood is excitement moving forward, looking forward to this. I know we are. And so, onward and upward. We just continue to do everything we can to make this service at LA Wave Options better for you, our subscribers. And we're going to continue to do that. We're not done. These are great things that are all coming out, but that's not the end of it. We're still going to keep moving forward with other ideas that we have as well. So with that, I'll sign off the same way I always do. We know time's the most valuable thing everybody has. We do appreciate it. And I don't just say that lightly. Very much appreciate when you devote some of your valuable time to us. And in turn, we do our best to make your use of that time informative and educational. And we hope you found this not just educational, but exciting, because we are really excited about this. I mean, we were like, holy cow, look at this. And then just wait till you see the time strategy. I'll teach you that one more time. It's going to be cool. So thanks for your attention again. Look forward to seeing you tomorrow.